I hope you can hear me. If you can someone just type in the question box, you can hear me clearly before we're going on. I appreciate that. Yes, great. Thank you very much. Thanks, Adele. Okay, great. Welcome to our webinar today. We're going to talk derivatives, more specifically contracts for difference, or CFDs. Like we do with every webinar, there's quite a few new names on the list. What we do with every webinar, we send out the PowerPoint presentation in the form of a PDF as well as a recording. So you'll be getting this, if you're on this webinar, you'll be getting a recording. And also any questions, just type in the question box and I'll try and answer them when we get to the end of the presentation. Okay. It should take about half an hour and we'll take the questions, as I say, afterwards. So this is my agenda for today. We're going to just very broadly discuss what are CFDs, some of the terminology around derivatives. We're going to compare it to equities, and then obviously look at the costs, and then compare between the two, the single stock futures and the CFDs, and discuss the pros and cons. At this point in time, I've only got examples of some long trades. So we were talking about that, and obviously linked to that will be the pros and cons of trading single stock futures. But just before we get going, while we're waiting for more people to log in, can I just ask you to quickly answer a quick poll? Gives me an idea of my audience. How many of you have traded single stock futures or CFDs before? Okay, I appreciate that. If you can just answer that quickly. Okay. Thank you for participating. So at this point in time, looks like about 70% of you have never traded single stock, traded CFDs before, and about 30% have. Okay. Excellent. Well, thanks for participating. Gives me, as I say, insight into the audience. Okay. So, what are CFDs? CFDs, as I mentioned just now, it stands for contracts for difference. It's a contract between a client and a stockbroker, in this instance obviously PSG Online. So the idea is that we're going to settle the difference between the opening price and the closing price. We buy something at 10 Rand today, we anticipate the price to go up, we sell it down the line at 15 Rand. That difference, that 5 Rand difference is your profit as such. So that is what a contract for difference is. It's a very simple product, acts as a stepping stone from equities into derivatives. When I say simple, it's less complicated or less complex compared to other derivatives, mainly because of the costs. But saying that it is still a derivative, so it derives its value on the underlying share. So you still have to do your homework, or be it on Sasol or Anglos. When I say do your homework, do the fundamental homework, do the technical homework. Obviously, most people use derivatives for trading, so technical analysis or timing is more important. But saying that, also risk management, most important when it comes to trading. At PSG Online, we only trade the top 100 companies. Number one, because they're tradable. Number two, obviously, a bit of quality companies. And obviously, they're more liquid and things like that. But what we do is we ask for initial margin or initial deposit on the top 40 companies. Obviously, they're large cap stocks. We ask for a 15% deposit. Sorry, there's a bit of a typo there. Whereas the next 60 companies, we ask for initial deposit or initial margin of 17.5%. Okay, so the bigger the bigger the risk, the more margin we ask. Remember, that deposit, you're earning interest, so that's always your money. That money gets ring-fenced, that funds get ring-fenced, the margin, and you're earning interest on it. But being a geared product, where we also talk about being using leverage, you're putting down 15% deposit and you're borrowing the other 85% to get that 100% exposure. So that's where we're talking about being a geared product. So if I'm putting down 15%, it means I got six times gearing. So for each cent that moves in your favor, you can multiply that up to 10 times. Okay. Obviously, that also applies for the opposite. If the market moves against you, you can also magnify your losses. Okay. That's why I said just now, very important that you manage your risk management and money management. Very important. We'll talk about that in a few slides' time. So you put out 15%, and that 15% deposit gets ring-fenced, and then on a daily basis, the share might move up and down, but you also have what we call a variation margin. This is where we talk about unrealized profits and losses on a daily basis, gets moved in and out your account. So we talk about a variation margin. I call it the top-up account, where on a daily basis, here at 5 o'clock in the afternoon, we have a mark-to-market process. So it depends where you bought it, and obviously where the market closes. So as I say, you buy at 10 Rand, and the market goes up in your favor. Let's say it goes to 11 Rand. That 1 Rand will be in your account tonight. You can actually use those funds tomorrow to trade other CFDs. But if it goes against you, obviously, as I say, that adverse price movement, instead of going up to 11 Rand, it drops to 9 Rand, 1 Rand will be taken out of your account tonight. You need to top up and keep that 15% there all the time. And that's where a lot of people don't understand the implications of gearing. So you can lose your initial deposit plus more. Okay, so we talk about a margin call on your statement every morning. If you don't have the additional cash available in your trading account, in your CFD account, you'll get what they call a margin call. We allow you up to 1,000 Rand. More than 1,000 Rand margin call, you'll get on your statement a margin call stating you need to make a deposit before 3 o'clock in the afternoon. Or alternatively, PSG has a right to close out X amount of shares to cover that shortfall. Okay, so that's where the risk comes in. If you don't understand that, it's very important that you get your head around that. So let's talk about some of the terminologies. The main thing about CFDs is that you can trade direction. So if say we talk about buying and selling, with derivatives, we talk about going long and short. So when you talk about opening a long position, you're buying because you're to take advantage of rising prices. If you want to take advantage of falling prices, we're talking about opening a short position. Now, when it comes to CFDs, some stocks you actually can't go short because they're not liquid enough, or we don't have enough script. Because remember, at the end of the day, PSG actually holds the shares as collateral. So if there's not enough shares in the marketplace to get a hold of, we don't allow you to do short positions. Okay, for example, Tiger Brands or Mr. Price, wherever the case might be. So you'll find on our list, and you see the list just now, most of the shares will have a B standing next to it. That stands for both. You can go both long and short, but some of them have a L, which means long only. You can't go short to those stocks. Okay. So that's where we talk about opening a position. If you want to close a position, obviously you do the opposites. You sell if you're long, and obviously buy if you're short. So if you buy something at 5 Rand, you sell it at 10 Rand, you make it 5 Rand difference. You want to take advantage of falling prices, you sell at 10 Rand, you buy back at 5 Rand, you're still making it 5 Rand. Okay, so you sell at 10 Rand, and you buy back at 5 Rand. Take advantage of those falling prices. Okay. So if you had to compare this to equities, on the left-hand side here, we've got investor A, that's trading equities or trading shares. We're going to use Cecil as an example. Let's have an example. She's got 55,000 Rand she wants to invest. I'm going to keep it simple. There's no brokerage cost here. So she wants to go buy 100 shares, and the share price, let's have an example, is trading at 550 Rand. She goes buys 100 shares. 3 months later, the share price has gone up 10%. She's made 10% on the 55,000 Rand. She made 5,500 Rand profit. As a percentage, return is 10%. So as an investor, you're not doing too bad. Okay, if you had to analyze it, you're doing pretty well. Now let's look at the same scenario now with someone that wants to trade a CFD. Also optimistic or confident that the share price is going to go up. Also goes and buys the share at 550 Rand. Okay, now with CFDs, you can actually buy the actual shares, underlying shares. In this scenario, it goes and buys exactly the same scenario, 100 shares, but instead of putting out 55,000 Rand, she only puts out an initial margin of roughly, or 15%, which in this situation, 8,250 Rand. Okay, so that gives them a gearing of 6.67 times. In other words, every 1 Rand movement on the underlying share, the CFD, it works out to 6 Rand 67. That's where the gearing comes in. So in our example again, after 3 months, we decided to take our profits. We close out, so we sell out our shares. Our profit, exactly the same scenario, 5,500 Rand, but that as a percentage of our initial deposit, our initial margin, is 66.67%. Okay. So that's where it gets more interesting. So first of all, you'll notice that CFDs are capital efficient. You don't need a whole lot of funds to be able to trade the underlying shares. You can actually open more positions with the same amount of money. Okay. If you had to compare that now to equities, now this is where the cost comes in. So they're capital efficient and also they're more affordable. So on our left-hand side here, bring my little cursor in here quickly. Okay, here's a CFD trade. I go buy 500 shares. So exactly the same scenario as buying equity shares. Both trading the same price. The difference is that if I had to multiply that 5 times 60 Rand, my exposure would be 30,000 Rand. But I only need to put down 4,500 Rand if this was a top 40 stock. Okay, 4,500 Rand as initial deposit instead of putting down 30,000 Rand. Okay, so if that was a mid-cap stock, I might have to put in a bit more, obviously slightly bit higher risk, and then obviously a bigger deposit. But look at what happens down my costs. We'll talk on the next slide. I'll show you how this all works out. Brokerage in this situation, 120 Rand to have exposure of 30,000. If it was a equity trade, it would have been 267 Rand. Okay, we'll pay that on top of my brokerage, same over here, but ultimately you can see my cost as a percentage on the opening leg is 0.46% as opposed to 1.3%. So as I said, they are very, very cheap to trade. And this is why trading CFDs have become so popular, because they are more affordable. So let's talk about trading costs. The minimum cost value of a CFD trade, at PSG we have one little requirement. The transaction value must be at least 25,000 Rand. So if this was a top 40 stock, you'll have to put down 3,750 Rand. If it's a mid-cap stock, you have to put down 4,375 Rand. So CFDs is not for everybody. If you had to compare it to single stock futures, obviously the margin requirement there is much lower in Rand terms. So just be aware of those. The margin requirement is much higher when it comes to CFDs. When it comes to brokerage, as I say, you pay 0.4% excluding VAT on the value of the transaction. But we are open to negotiate those rates for the large and active traders. Okay, so we are open for that, but obviously they must be large and active. If I'm putting down 15% and I'm borrowing the other 85%, obviously there's interest involved. So we charge interest for that. It's what they call SAFX plus 2, which is roughly at the moment prime plus 2. Okay, so it's about 7.25%. Okay. When it comes to CFDs and going short, just understand there's additional cost. There's what they call a scrip lending fee. It's a fee of 1.5% per annum charged on the sold position, and that's charged on a daily basis, or a minimum of 250 Rand. Now, I suggest rather open up a single stock futures account. It doesn't cost you anything. Remember, a BDA, the CFD and a single stock futures account doesn't accrue that 40 Rand BDA fee every month, so it doesn't cost you anything extra. Just also understand that PSG allow up to a maximum of R1 million exposure between the two accounts. Okay, if you want more than that's without a balance sheet. If you want more than that, obviously we want more collateral and things like that. Just understand there's additional cost when it comes to going short on CFDs. I suggest rather use single stock futures. So here's a practical example. Let's say again going back to our scenario of Sasol shares. We go buy them at 550 Rand. So my exposure is 55,000. My initial margin at 15%, I'm putting down 8,250 Rand. Okay, so that's for my gearing, 6.7. We discussed already. My brokerage is 0.4%, 220 Rand. If that was an equity trade, okay, it would have been 225 Rand just on the first 25,000. Because remember, it works on a sliding scale. So ultimately, you would have paid 480 Rand altogether. Sorry, that's right. Yeah, 40 altogether, as opposed to 220 Rand. Okay, so it's very, very cheap. My VAT on my brokerage, 30 Rand. So my total is 250 Rand. My interest, okay, so it's 8.5% on a daily basis. That's my value of my exposure, 8.5%. That's my the interest divided by on a daily basis of 12.81 per day. Okay, so that's what you're paying. So as long as the share price is moving in your favor, your interest should be covered. Okay. Also, your deposit will be receiving some interest every day. Okay, so it's obviously slightly a bit lower, but you are receiving interest. Okay. If you compare the two together, the big thing about CFDs, they trade OTC, so they're not regulated. Remember, single stock futures are regulated, so PSG has decided to stay with CFDs. I know that the JSEs launched their own, what they call CFDs, but we're staying with this version. We've been trading CFDs going on 6-7 years now. So the biggest thing for a lot of people is obviously that peace of mind. So if you know you're dealing with PSG, a reputable organization, that shouldn't be a big problem. So the big thing here, if it's regulated, obviously single stock futures, all the transactions are guaranteed, where this is not guaranteed on CFDs. Okay. I find that single stock futures are slightly a bit more expensive because of that 60 Rand booking fee, whereas CFDs we don't charge a 60 Rand booking fee. So you save that 60 Rand on each opening level of transaction. You can go short with single stock futures because there's no script lending fee, whereas obviously on CFDs there is a script lending fee. Remember, with futures, it's a bigger future, it's got a life, so there's a rollover cost, 0.25%. So on a quarterly basis, if you're a CFD investor and you're a CFD trader, you can be a position trader and hold it from a few weeks to months to years, you actually save yourself 1% per annum. Okay, so those things you have to take into consideration. And the other big thing is that that single stock futures can be converted over into equities where CFDs can't. Okay, so those are some of the major big differences. Okay, so let's talk about some of the trades we've put out the last few weeks or so. Those of you that get my daily investment update, these are the 3 last trades that we had. We closed out this trade yesterday, MMI. We put on this trade on the 17th of October. Let's say, for example, you had UCFDs, the buy, you'd have gone long. That was our entry price, 26.12 Rand. So we were anticipating the market to bounce off here. So yes, it was a bit of an aggressive trade, trading just below that 200-day moving average. And I think we did mention that it is an aggressive trade. Our target price was as moving averages up top here, 29.70, and our stop loss was just slightly below here. Okay, so this is where you want to start looking at risk management and money management. So the first thing you want to look at is the risk-reward ratio. So in this situation, my risk-reward ratio, I'm willing to risk 1 Rand to make 3.20 Rand. Okay, how's that calculated? My risk, it's the difference between my entry price and my stop loss. In this situation, was 1.12 Rand. My difference between my entry price and my target price was 3.58 Rand. Okay, so that's how I calculate the risk-reward ratio. So you should never ever go into a trade where the reward ratio is less than 1 to 2. I'm willing to risk 1 Rand to make 2 Rand. So this is what we call prudent trading. Some of you might go for a bit slightly lower ratios. We call that aggressive traders. But I like to bend the odds in my favor and use a bit more probabilities. But the potential reward in this trade was 13.71%. Remember, this is a CFD, so as a percentage of my 15%, I had a potential of making 78%. Okay, so that was our risk side. If I was starting with 100,000 Rand capital, now we start looking at money management. You should never allocate more than 2% risk per trade. Okay, so I'm willing to risk 2% capital per trade. So in this situation, 2% of my 100,000, 2,000 Rand. I take a 2,000 Rand divided by my stop loss, which is 112. Okay, so in this situation, I get a scenario where it tells me my position sizing. I can go and buy 1,786 shares, or ultimately, as I say, CFD contracts. Okay, so as I say, the share moved up nicely, it bounced up nicely out of this, and moved up out of that little channel, it moved up nicely. As it moved up, we actually moved our stop loss. That was our original stop loss was 25 Rand. We moved it up. As we moved into profit, we moved it into our stop loss level up. As I say, yesterday we closed out the trade for 13.71 profit. So we closed that at 29 at 70 yesterday. It went as high as 29, or closed at 29.76 yesterday. That wasn't too shabby, and that was from the 17th of October. Okay. So our average trade is about 12 days, what we call a swing trade. So the point I'm trying to make is that risk management and money management are very important when it comes to trading. And do all this kind of paperwork on paper before putting on the trade. This is breweries. We went into this trade on the 20th of October. We closed this trade out on the 7th of November, last Friday. Again, there's our entry level. That's our target price. and that was our stop. Okay, so we saw this little breakout out of this little narrow down channel. We had this breakout above that resistance trend line. We were oversold on the two oscillators, so that's how we put the trade on. In this scenario, again, we just met that criteria, 1 to 2, so 8%, and this trade went up nicely. In this situation, yes, you would have bought 87 shares. We originally revised our stop up from 561. We moved it up to 584, locking in the profits. And on the 7th of November, we closed out that trade at 822. We closed out at our target price. Okay, so it wasn't too shabby either. So the last 3 trades have been quite nice for us. And then Discovery, this was quite a while ago, nearly more than a month ago, on the 14th of October. In this situation also, we made a 7% profit. Okay, so when you get this presentation, just look at it and you can revise it and check how we've done from there. But as I say, the main point I want to highlight, risk and money management, most important when you're trading derivatives. Okay, so how do we trade derivatives? First of all, obviously, you need to register for a CFD account. You need to open up an account, separate mandate, separate risks. So if you do have your FICA, the process should be quite easy. But you can do everything online. But once you've opened up a trading account, your CFD account, on our website, by the way, if you click on indices and then click on the indices, and you'll find a little button here called futures, and there's a little tab called CFDs. You'll get the list of all the stocks, and this is going by share code, and it gives you the margin requirements, so 17.5%. What I like to do is I take this list, I highlight it, copy it, right mouse click copy, and I put it into Excel spreadsheet. And from Excel spreadsheet, I rank this column on 17.5% or 15%, so I can see which ones are large caps and which ones are mid cap, and then so I can play around with the list from there. Okay, so just move my cursor quickly out of the way. Once you've logged into your account and you start trading, this is what the holding account would look like. It looks exactly the same like your equity account. Only things now you'll have long or shorts here. Okay, all these trades in this situation are long. You can see what kind of stocks they're trading at. What's nice about it, this way you start looking at the margin. Okay, so I'm putting down a small little margin to have a big exposure. Okay, with CFDs, you can have 10 different positions open. I just find it's easier if I'm a bit more actively trading as a swing trader. I find most I can handle is about 5. So some people can have a bit more than that. Okay. So how would you trade? Exactly the same way as you would trade equity. You've done your homework now. I go click on new order. Okay, I type in the share code SASL, because that's what we were using example, SASL. I click on go. Gives me a snapshot, what's happening with the share price, the bids and offers. There it tells me margin required. There it tells me my my estimated value you saw just now. Okay, so on the go long. I want to take advantage of the rising prices. I select the option here called long. I think it'll be on the next page here. Okay, so first of all, select order. Whoops, let me just go back. Okay, long open. How many shares I want to buy? 100 shares. I know in our example I was talking just now. Sorry, I was getting mixed up with breweries. Here's 100 shares. That's my price. You'll see these are grayed out. It's only for today. At 5 o'clock, if your order is not met, the order gets cancelled. Okay, so I click on submit. Like in the realm with equities, when you need a willing, remember I'm buying, so I need a willing seller. It's going to agree on that price, and obviously the amount of shares to trade. So it'll be sitting there in my order book, and at such time I have a willing seller, the order's matched, and it'll appear in my holdings account straight away. Okay, so as soon as you bought the share, or as soon as you got into the contract, very important you come back, click on new order again. Okay, then you can bring my cursor in, bring my new order in, click on new order, okay, click on price watch. Okay, and this is where you start bringing your stop loss facility. Very important that you use a price watch and a stop order together. Okay, let me explain how this works. Your price watch acts like your trigger. So remember, I'm long. If the market falls, it goes against me. So in this situation, let's say example, if it drops below 500 Rand a share, okay, and what is a trigger going to the market as a sell order. Okay, so that's very important. You set that up first of all. So your price watch is your trigger. Secondly, my stop order is my bullet. So what happens if it gets triggered? What the system wants you to do? What the system asks you what you want to do? I want to close out my whole position. I want to close out, sell all the 100 shares, and at what price? Worst case scenario, £2 lower, but where will it be trading? At 500 Rand. Okay, so the two of them have to work together. If you only have a price watch and not a stop order, you got to get an SMS or email and just to tell you that the order has been triggered. Okay, so it's very important you use them together. Also very important, by the way, to put in your username, your email, and your cell phone number. So when it gets alerted, you get a notification. Okay, so hopefully you've seen some of the pros and cons around trading CFDs. They're very, as I say, very simple products to trade. If you understand how equities move and supply and demand and market sentiment, very, very similar. So you'll see that there's more advantages than disadvantages. They are capital efficient. Just understand minimum exposure is 25,000. Okay. Low trading costs, 0.4% plus VAT. Very easy. There's no expiry date like with single stock futures, so you save on rollover costs. As I say, it's great for the position trader. Position trader is an active investor. They want to take advantage of more of the cycles, that kind of stuff. You can hedge your portfolio if you want to for shorts. I got a question mark there. I prefer rather using CFD as single stock futures because obviously the costs. But you have all the other benefits of capital growth. So the share goes up, you're getting that capital growth. And one other big major advantage of CFDs, you're getting a dividend income. Okay, you're getting a synthetic dividend, which is taxable, but all dividends are taxable now anyway. Whereas opposed to single stock futures, we trade dividend neutral contracts. It's priced into the price already. You don't actually receive it. Okay, so yeah, you actually get the dividend. So obviously our trading platform, we'll give you what they call DMA, the direct market access. The prices you're seeing is the prices trading at the JSE. Another thing is you can place your orders after hours. If you press your time, you can set up alerts. If it gets triggered at a certain level, the order going to the market when the market opens. And you saw just now, obviously, you can also use stops. Okay, but there are more advantages than disadvantages. The biggest thing here, obviously, the value. So the margin required might be slightly higher for some people. Understand that there is a minimum cost of 250 Rand you want to go short, so which can be which is a disadvantage. Gearing and risk can be a disadvantage if you don't understand how they work. But if you understand how they work, you can use it in your favor. But most important, obviously, is managing that risk. And lastly, obviously, I can have 1,000 CFD contracts on Sasol. I cannot go to the AGM and vote because I'm not a shareholder. Okay, so those are just some of the things you must take note of. Okay, so let me just quickly summarize this before we read the questions. As I say, they are simple geared products, they're capital efficient, they're more affordable, cheap for most people. Obviously, you receive that synthetic dividend and ideal for position trading. The main thing I want you to understand from this presentation is, yes, I want to talk more about CFDs themselves, that's the product knowledge. There's additional information available on our website. You can click on those links when you get the presentation. It goes into more some CFDs examples and things like that. But if you've got any questions, you're welcome to drop me an email and things like that. So in conclusion, those of you that have never traded before, I suggest you paper trade. Unfortunately, at this point in time, PSG do not have a CFD simulator. I suggest you either create a little Excel spreadsheet and do some paper trading. Alternatively, you can also go to the JSC's website. They do have a virtual trader. The whole idea is to understand how to go long and short. So a lot of us find it difficult to go short, sell something we don't have. So getting our head around that. But also just understand how the flow of money moves in and out your account on a daily basis. That mark-to-market process. But start small. The main idea is for you to gain confidence. Number one is obviously in your stock picking abilities. And number two, obviously, understand how the platform works. I suggest that you only get involved with CFDs if you understand how equities work. So maybe trade some equities for a bit. There is an equity simulator. Play around with that. That'll give you more confidence. But if I can, again, just reiterate for you guys, risk and money management is the most important. It's about making money, it's avoiding capital losses. So, yes, we talk about methodology, we talk about money management, and very, very closely linked to that is the mindset, so controlling those emotions. It's all very well playing around in a simulated environment. It's not real money. When you start tracking your real money, that's when the voices start talking. So it's controlling those emotions. So just remember, with CFDs, we allow up to R1,000,000 exposure. Okay, more than that, we do need a collateral, more collateral balance sheet. Okay. So before we hit any questions from my side, good luck and happy trading. Just quickly, I've got a few more webinars left for the year. I'm off to Las Vegas for a conference from Monday. I'm only back in 2 weeks' time. We're discussing the second part of this presentation, which is trading single stock futures, and then that'll be the end of November. Beginning of December again, we got Dr. David Paul from VectorVest. He's going to talk about finding stocks that are growing earnings aggressively and safely. And then those of you who were on my presentation last night at the JSC, we had some technical difficulties. We lost our internet connection. But those of you who missed it, I do have another session on the 12th of December. It'll be the last one for the year. I'll be discussing investment clubs. Those of you down in Cape Town, it's my last Traders Forum for the year. Please come along the 2nd of December. Okay. So thank you very much. There's my contact details. Let me see what questions are coming through here. Okay. And before I hit any questions, let me just quickly ask that second poll. See how you guys did. We had a 70% chance, 70% people have never traded before. So let me see how this presentation pans out for you guys. How many of you would now? Those of you who've never traded before. Okay. So some of you still need some more information. That's great. I don't mind. So there's my email address. Please drop me email. Tell me exactly what specifically you want more information on. Let me see what kind of questions we're getting here. Whoops. Presentation has froze. Okay, who's the shareholder? PSG. Yes. Okay, Sean, that answers your question. Yes, PSG obviously will be the shareholder. Okay, I would like to talk a bit more on short trades and the concept. Okay, this is a question from Johan. Johan, I don't know you obviously do technical analysis. You find a share that's overbought, the top of the cycle. You go short. So on our trading platform, there's a button say short open. You put in your price. So you anticipate prices to fall. So I'll sell at 10 Rand. The prices fall, gets back to 5 Rand. I'll buy back. I close out the position. So very simple. I don't know how to maybe explain it easier for you guys. Okay, as I was anticipating this question about capital gains. Yes, CFDs and all derivative products are considered income by the receiver of revenue. So capital gains tax does not apply. It's all income tax. So whatever profit you make, you have to declare that profit. You add it to your personal income tax, and every year, obviously, and then you pay tax on that. So definitely not capital gains. It's all classified as income tax. Do you pay interest on full exposure? Yes. Okay. So you pay on the full exposure, but obviously you get back on your deposit. Okay. Angelo, yeah, this presentation will ultimately one day be on YouTube. We're using a third-party resource to put it out. But as I said, I'll be sending you the presentation anyway, or the link to it. You can always go view the presentation there. Okay. Great. That's all the questions. Okay, so we're getting to about a 50-50. So those of you who have never traded before, 50% have said that you will start trading CFDs. Some of you still say that you want more information. Great. I appreciate it. So, guys, I hope you've enjoyed this. Thanks, Eleanor. Pleasure. Okay, thanks. Please show your email address again. It should still be on the screen, Peter. Okay, my email address is Sean, SHAUN, VDB, Victor, Delta, Bravo, at PSG, Papa Sierra Golf, .co.za. Okay, so you guys are welcome to drop me emails and find out exactly what you're looking for. Okay, so that looks like it's all the questions, guys. Thanks a lot. Pleasure, Eleanor. Thanks, Johan. Thanks, Shaunos. Thanks, Santi. Okay. Good. Thanks a lot. Okay. So until next time, we'll talk to you guys in 2 weeks' time. Thanks for participating. Thanks for being on this webinar. All the best. Keep well. Bye-bye.